You know, the AI boom has felt pretty unstoppable, right? A story of pure, unadulterated technological progress. But what happens when that amazing story smacks right into cold, hard financial reality? Well, today, we're diving into a huge shift in the AI world, a story that really pits a high-stakes gambler against a financial fortress. Let's get into it.
So it all kind of came to a head on December 10th. Oracle, a company that's absolutely key to building the AI backbone we all rely on, just shocked the market. It triggered one of its biggest stock sell-offs of the year. But here's the interesting part. Investors weren't spooked by the tech, not at all. They were reacting to the absolutely staggering cost of making it all happen.
And that really brings us to the core question of this whole thing. It's not about whether the AI innovation is real. It absolutely is. But if you look at the history of tech bubbles, the real danger, well, it often comes from somewhere else entirely.
And here it is. This is the central idea. The biggest risk in this whole AI gold rush isn't that the technology fails. It's the sheer, mind-boggling cost of building it. In other words, it's a financing risk. When the money going out gets way ahead of the money coming in, that's when things get really dangerous.
So let's start with the event that sent shockwaves through Wall Street, what I'm calling the AI spending shock.
And this brings us directly to our first major player, Oracle. Now, Oracle has gone all in on AI. I mean, they're betting the farm. But as we're about to see, that super aggressive strategy has uncovered a massive financial problem lurking just under the surface. A serious cash burn problem.
Okay, this was the number that just stopped everyone in their tracks. $50 billion. Oracle announced it was planning to spend that much in a single year. To try and put that into perspective for you,
This chart right here lays it all out. That $50 billion in new spending, it's more than double its annual operating cash flow, which sits at around $22 billion. I mean, that's a fundamental disconnect between what you're spending and what you're earning.
So the bottom line is this. It creates an annual cash shortfall of about $28 billion. Think about it in terms of your own finances. It's like planning to spend $28 billion more than you make in a year. This isn't just a bad quarter. This is a structural, ongoing problem.
So where's all this money coming from? One word, debt. Oracle's total debt has absolutely ballooned to over $100 billion. And at the same time, its cash reserves are looking dangerously thin. They're borrowing money at a pace that's making both investors and the credit markets really nervous.
And this leads to a very real risk for anyone who owns their stock. See, if Oracle can't keep borrowing, it might have to issue more shares to raise cash. That's called equity dilution. And what it really means is that existing shareholders could see their piece of the pie get smaller, all to pay for these brand new data centers.
But the spending issue is just one part of the story. It's actually made much worse by another major risk factor. Oracle is basically making a gigantic bet on a single customer.
Yep, that massive $50 billion spending spree is almost entirely to support one client, OpenAI. The two companies are joined at the hip through a colossal $300 billion five-year cloud deal. Now, in finance, this is a classic textbook problem called concentration risk. The deal is huge, sure, but it also means Oracle's entire future is tied to OpenAI's. What happens if OpenAI's growth slows down? Or what if they decide to start building their own hardware? Suddenly, Oracle could be left holding billions in equipment with nobody to use it.
Okay, so that's Oracle's high wire act. Now let's switch gears and look at the complete opposite approach. While Oracle is piling on debt, Alphabet, that's Google's parent company, is playing a totally different game. They're building a financial fortress. I mean, you don't even need to be an accountant to see this. The numbers tell the whole story. Oracle has over $100 billion in debt. Alphabet, a relatively tiny $21 billion. And oh yeah, they're sitting on a literal mountain of cash, almost $98 billion. It's like night and day.
And their actions just prove the point. Oracle is out there desperately trying to fund its expansion. Meanwhile, what's Alphabet up to? They are so flush with cash that they just authorized a $70 billion share buyback. They are literally giving money back to investors.
So, what's Alphabet's secret weapon here? Well, it's a really powerful strategy called vertical integration. Instead of buying all the different parts from other companies, you control the whole process yourself. And in the world of AI, that starts with the chip.
See, you've probably heard people talk about the Nvidia tax, right? It's that premium that companies like Oracle have to pay for those incredible high-demand chips. Well, Google just sidesteps it.
They design their own custom AI chips called Tensor Processing Units, or TPUs. By controlling the entire hardware and software stack, they can slash their AI costs by an estimated 30 to 50%. That is a massive, massive competitive advantage.
So, what happens when you put these two completely different strategies side by side? It's leading to a major shift that analysts are now calling the Great AI Rotation, as investors start moving their money from the high-risk gambles to the more stable players. So let's just recap this showdown. On one side you have Oracle, funding its dreams with debt, betting the entire farm on one customer, and paying that premium Nvidia tax. And on the other side you have Alphabet, funding everything with its own cash, with a super diverse customer base, and slashing costs by building its own custom chips.
So the key takeaway here is actually pretty simple. In a capital-intensive race like AI, the winner isn't necessarily the company that spends the most money the fastest. No, it's the one that can actually afford to fund that growth sustainably without putting its entire balance sheet on the line.
And this leaves us with one final thought. As the AI boom starts to mature, the market is shifting its focus away from just hype and toward the fundamentals. It's a huge reminder that in any gold rush, the winners aren't always the flashiest prospectors. Often, they're the ones who build the most enduring, stable operations. So the question is, in this race for AI dominance, who really wins? The fastest spender or the